Welcome, my name is Vishal Texanani. Today I'm speaking to the Chief Investment Officer of Montgomery Investment Management, Roger Montgomery, and we're going to focus on Telstra and Telstra's new strategy that the company unveiled at its Investor Day yesterday. Roger, always great to have you here. How are you?
I'm great, thank you for having me.
No problem. Now, Roger, before I fire off the questions, I just want to share a few interesting stats with you and our audience about nabtrade customer holdings in Telstra. So Telstra is the 7th biggest holding on nabtrade, and 20% of our customer accounts actually hold Telstra shares. Since July 2016, the quantity of Telstra shares held on nabtrade has increased by 51%, so our customers have been buying on the dip, and the number of accounts holding Telstra shares has increased by 36%. So it looks like as the Telstra's share price declined, customers have been initiating new positions in the telco, and we'll talk more about that as we go through our conversation. But let's get to the meat of the matter. Telstra 2022. The name of the strategy that Telstra unveiled yesterday. Help us dissect what it means, what the company's trying to do here.
So it's pretty simple. There's really three prongs the way we see it. Number one, create a more efficient cost base.
Yep.
So that means make it cheaper to run, make it leaner, and there's plenty of excess fat there that can be cut.
8,000 jobs, right?
Indeed. Jobs and labour is one part of it. The other part of the strategy is also a fairly simple one, and that is to ensure that the scale advantages that Telstra has, and scale is very important in telecommunications, to ensure that they maintain those scale advantages. So that means cutting prices, and we can talk about this in more detail in a moment, but effectively it means cutting prices so as not to cede market share. And the third part of the strategy is to reinvest in the business, or be prepared to invest a lot of money and structure the business in such a way that they can invest a lot of money in the imminent rollout of 5G.
Okay, so what's your assessment of the strategy as someone who's actually started buying Telstra shares, and we'll talk more about that as well. What's your assessment on whether this strategy is going to be a good deal for investors or not? Well,
let's put one thing out there, and that is that there was also in yesterday's announcement, there was a cut to the earnings expectations. So the company has reduced its operating earnings over the last couple of years by about $1.3 or $1.4 billion a year in each of those years. That's not going to change very much. In fact, earnings are expected to continue declining by some analysts out to 2022. So still for another 3 years of earnings declines. So put that to one side. Now, in answer to the question, is it good for shareholders? Well, we think it's the right strategy. They need to be able to do this. It sort of reminds me a little bit of the strategy that Qantas engaged in when Virgin decided to start cherry picking routes. Yep. And so what happened there is Qantas decided to innovate. They decided to reinvest in capacity, and then they cut costs, which is exactly what Telstra's talking about doing. And it made it much harder and more expensive for Virgin shareholders to tolerate the strategy that they were implementing. It made it more expensive for them. And so we think that this strategy is the right strategy. It will make it more expensive for competitors. It will ensure that they're more efficient, Telstra's more efficient and has capacity to invest in 5G. So in the long run, in the very long run, it probably is a good strategy. But the market at the moment is focused very much on the short term.
Okay, and so you've become a buyer of Telstra shares at this price?
We've recently started buying Telstra shares.
And you were a bearer of Telstra for a long time now.
Yeah, so it hit its high. It's interesting. It hit its high, and I won't forget it. It's on the 13th. It was the 13th of February 2015. The following weekend, on the 21st of February 2015, I wrote an article in The Australian saying that investors chasing Telstra for its 6% yield are making a big mistake. They're going to lose much more than the dividend over the next few years, and that's exactly what happened. The share price is now off about 60%. It's gone from $6.59 to circa $2.70. Now, the market is fearful of a dividend cut. You can see that because the current yield is about 10.8%, which is crazy. That tells you that
yield trap. Yep.
It's a yield trap. Investors, it means that nobody's expecting the current dividend to be sustained. The decline in earnings, which I talked about earlier, is already factored into the price. The dividend decline is probably factored into the price as well. We can't see any new catalysts that aren't known to the market. We can't see anything sort of a black swan left field event that's going to cause the share price to fall dramatically from here. It might grind lower as the register of shareholders changes. So those people who believed that it would be a good dividend stock, they get out. And we get a new group of shareholders who are investing for the growth. We believe the shares are at a discount of about, call it 10%, a 10% discount or 15% discount to what we think the shares are worth.
Yeah.
We're not expecting growth. In fact, in our own modelling, we think that the earnings will continue to decline.
Yeah.
But we believe that even factoring those declines in, it still looks relatively cheap. And in an expensive market more so. Everything else is a lot more expensive. But we also think that there'll be some surprises further down the track, particularly around the rollout of 5G and the various bundling that can occur when new devices are attached. You've got to remember there's no 5G handsets that have been sent out or no one's receiving 5G handsets at the moment. That will accelerate, that will be much faster than people expect. And most of the profits all around the world in the telecommunication space, most of the profits flow to the companies with the most scale and the biggest customer base. So yes, they're cutting their margin so as not to cede market share, but that ultimately will result in more customers signing up with Telstra when 5G rolls out, and that could be a catalyst for a re-rating of the stock, and that's how we think we'll make some money out of the company.
Okay, so you would have done your numbers. What kind of total shareholder returns are you expecting on an annual basis?
Yeah, it's a little bit hard to, we're using a 9% discount rate to value Telstra. So we would expect over the long run in aggregate to get a return of about our discount rate.
9%.
About 9%.
About 9%. Okay. So what's the?
But that's not to say it could be this year. This year it could fall 20%. I don't know what the share price is going to do. We just think in the long run, the return that we get will be better, much better than cash.
Okay. We talked about before the interview execution risks. So this is a big strategy. It's a big piece of work. What would you say is the risk of this strategy not turning out, and how are you managing that risk as a fund manager? Do you have a portfolio cap on the position?
So we do have a portfolio cap, and we've only bought about 1.5% or maybe just slightly less than 2% of our entire portfolio in Telstra. We expect to increase that, and that would happen if the share price fell more.
Yep.
It could also happen if our valuation rose as a result of faster execution or better outcomes than what the company was suggesting at the strategy day yesterday. We think they've got even more capacity to cut costs. We think they've got the capacity to do better than what they said they were going to do, and in time we'll see whether or not that plays out.
Okay, so Telstra is looking cheap. It's got a potential for re-rating, but there is a risk. Be
There's always
diversified
risks.
And cap your portfolio limit.
Indeed.
Roger, thank you so much for coming in, for your time and for sharing insights on what's happening with Telstra.
It's a pleasure. Thanks, Vish.
No worries. I hope you enjoyed this video. Now, please remember what we talked about today isn't a recommendation to transact in Telstra's shares. Please do consider what you do with Telstra very, very carefully. Do your research. Consider seeking financial advice. My name is Vishal Texalani, and I'll see you next time.